So our next question is kind of on ESG investing. Environmental, social, and governance investing. Um, I heard that ESG investing, I will underperform the market. Is that true? Like, I want to be a responsible investor, but I don't really want to put myself behind because of it.
Yeah. So what they're doing here is this is the old socially responsible investing. They've had a lot of different names, impact investing. There's a whole bunch of things, but the new concept is now called ESG. And so how does a company handle the environment? Is the E? How does a company handle the social portion, which would be the employees, the community that they're in, and then the governance. Really, what's the board look like? How does that company run in terms of a governance standpoint? And they rank all these companies now, and they can put these companies together just based on their ranking in these big baskets. You can buy them in an exchange traded fund, and we have ESG portfolios. And so the in the old days, what was happening was that the only way you could get socially responsible investing was through a mutual fund, and you had a manager who had to dig through all of these factors to try to figure out whether that company should be in the portfolio or not. And now what's happened is we have these big companies giving ratings to all of the companies that are out there, almost all the companies that are out there. And so it's much, much cheaper to put that basket together just using those ratings. And that's a big difference. And then now we're using exchange traded fund, which are generally cheaper than the mutual funds also. So it used to be that was socially responsible investing that we saw lower rates of return because the expenses were higher. So in other words, if I have one portfolio, my traditional model over here that has a 0.25% internal cost versus say, the old social responsible investing model that cost 1.25% internal cost, it's going to be hard long term to beat that traditional model with a 1% less internal cost. Now the internal cost differential is almost negligible. It's in some cases it's basically zero. And so that made a huge difference. And it also then allowed for more cash flow to come in. So we're starting to see, lots of money come into, a lot more money than there used to be coming into these exchange traded funds. And so they're being focused on these stocks that have good ESG ratings. And so what we have seen, at least, in our business, the ESG is holding its own. It's been, above the traditional, slightly below it, but I would not say that you are going to be making less. I would say actually, if there's a guest coming up here, you might be making more in the ESG side. It's one of the reasons why we put two giant pieces of ESG in our traditional model, which have been working out pretty well too. So, um, but one of the things that is important to understand when you look at kind of the screening that they do in ESG, a lot of companies that have higher ratings, better ratings, are a lot of growth related companies. And so overall, growth has been outperforming, right? And there's some value been doing a little bit better this year. But if you look over the last 10 years, growth is outperforming. So, in a way, what's happening with ESG has a lot to do with how growth is going to play out as a whole. But no, you can get very diversified portfolios, in my opinion, and have a nice situation. And at least in the last 2 or 3 years here in the portfolios that we've been managing, we haven't seen a drop off in return really at all. In some cases, it's outperformed our traditional model. So it's a good question. It's a question that gets asked all the time. You get a lot of people that are traditional investors and they're just barely kind of ESG investors, and they really don't want to go there because they're afraid they're going to make less money. The rest of the people that are already ESG investors are there just because of their belief system. They don't want to invest in these other companies. They want something cleaner, in essence, and that's okay too. And that's been a big part of our practice. So I would definitely not discount ESG.
So going off of that, you talked about how ESG is kind of leaning towards growth. Is there a way to kind of protect myself if I were to do ESG investing so I don't kind of overweight growth too much and kind of lose out on value too?
Um, Yeah, that gets to be a little bit difficult because of the fact that you do have a screen in place. And that screen, so for example, software companies, like a Microsoft or what have you, tend to be very highly rated because they really don't have a huge impact on the environment, for example, and whatnot. And they don't have factories and child labor, and these different things. And so you can end up with a concentration of, say, software companies and not some of the other things on the value side. And value generally has a lot of kind of older industry, which doesn't have as high of a rating. One way you can do that is to buy these more broad based ESG portfolios. Like, for example, Vanguard has the total stock market index, which is VTI, right? So that's the broad market. And now they also have that same index where they apply the ESG screen to all of those stocks. And that does pretty well, even in value run. It's not as tight on the ESG side. So it just depends on what your thought is. I have a lot of clients who don't care about the return as much as they care about the environmental impact. And that's those clients have been in social responsible from the beginning, back in the 80s when I started, and they knew they were going to make less money. They didn't care. And so they're still okay, even if it doesn't have the value and the balance. But those people that are kind of in between, that's where you can create a little bit more broad-based ESG portfolio. We'll incorporate a bit more value into it because they're kind of lowering the standards a little bit. So anyway, there are ways to do it in that regards, and so it's just a matter of kind of getting out there and figuring out how to structure that portfolio correctly, and it's worked out really well so far.